Welcome, ladies and gentlemen. I pray and I believe that we are all doing well. We are welcome to the next session of our class. That is Financial Accounting Paper 1.1. Today we are looking at Chapter 6, Non-Current Assets and Depreciation. Non-current assets and depreciation. Good. Now, what are we expected to know? What are we expected to know? What are the learning objectives? Good. Now, at the end of this chapter, we are expected to have a deeper understanding of one, non-current assets, that is, i.e., what is property, plant, and equipment, and other keywords, terminologies. We must familiarize ourselves with what is PPE or what is a non-current asset. Okay, great. The next thing is to talk about depreciation and carrying amount. Depreciation and carrying amount, because as an asset is being used in a business organization, it is normal that the assets will go through wear and tear. Okay, and so how do we determine depreciation, okay, and carrying amount of an item of what? PPE. Okay, good. From there, we will look at the various methods of calculating depreciation. We'll look at the various methods of calculating depreciation. Then we'll look at subsequent measurement of PPE. Okay, once an asset is acquired, do we keep it at the cost at which the asset was acquired, or is there any other way of measuring that asset? We'll look at that. And finally, we'll look at intangible assets. However, this discussion will be centered on accounting for non-current assets with specific emphasis on the tangible assets. Okay, great. All right, so the assets, that's a brief introduction, right? Good. The assets of a business are classified as current assets or non-current assets. Okay, a business will have two forms of assets. We have what is called current assets and non-current assets. Good. Now, according to IAS 1, that is presentation and preparation of financial statements. Now, it defines current assets and then states that all other assets should be classified as non-current assets. Okay, so IAS 1 presentation of financial statements has given us a definition of what a current asset is. And therefore, if a particular business asset does not fall within the definition of a current asset, then it is expected that that asset be classed as a non-current asset. Good. When we talk about current assets, what do we mean? Current assets include cash, receivables, prepayments, and inventory. Now, they are all items that will be used or recovered in the short term. They are all items that will be used or recovered in the short term. So let's take, for example, cash. Cash is a liquid resource and which is available to the business for use, okay, within the shortest possible time. Receivables, for example, represents the value of those customers that you sold goods to for which they were not able to make immediate payment. Now, it is expected that in business, when someone owes you, okay, that person should be given a shorter period of time within which to pay. And normally, it doesn't have to extend beyond one accounting period. So you can see that it is recoverable within the shortest possible time. Okay, or they do not go beyond a year. Don't forget that the business is such that you may have acquired the business on credit from your suppliers. Now there is a need for you to sell the goods to your customers on credit. Take some time to collect that amount before some cash becomes available for you to go and pay your suppliers. And therefore, it is important that you do not allow so much time between the time you sell the goods and the time you get back your money, because you need that money to be able to settle your supplies. Do you get a point? Good. Then talk about prepayment. For example, if a business happens to pay for, say, electricity expense, or say a rent of its business premise, assuming the business premises has been rented, and therefore the landlord demands payment of say 2 years rent in advance, what is expected is that because for the business accounts or prepares financial statement for every year, then whatever amount that the business has paid over and above the rent for the year should be considered as a prepaid expense. Or if, for example, you happen to do your insurance of a vehicle, of a building, of any asset of the business, and that insurance travels beyond one accounting period or struggles between two accounting periods, then what you do is that you have to recognize the proportionate share of the insurance or the rent expense that relates to that accounting. For example, you have paid for rent for a factory or an insurance of a building, and the insurance maybe from 1st July to 30th June of the following year. What is expected is that because you're preparing an account for the very first year, you have to consider the portion of the rent or insurance that falls within the accounting period. So if your accounting year end is say 31st December, that is from 1st January to 31st December each year, and you have paid something which covers from July of one year to June of the other year. Now you have to only consider the rent or the insurance that you have paid and which relates to the first accounting period, which is from July to December of the first year. Do you get a point? Now the essence, that is the one from January of the following year to June of the next of that same year, becomes a prepaid expense. Okay, it does not relate to the current accounting period, and so it should be treated. And because in the next year we just have less than say a year to get into the next year, that is why that amount of insurance prepaid is seen as what as an asset, because it will be covered over the short term. Good. You can talk about items of inventory. No business obtains its inventory with the intention of keeping the inventory for more than accounting year. How do they raise money? How do they get money to fund other business operations? Great. So current assets are assets such as cash, receivables, prepayment, and inventory. That and the business expects to use this asset or to recover this asset within the shortest possible time. Now, when it comes to a non-current asset, we are saying that it's an asset which is used by the business over a number of years. Non-current assets is an asset which is used by the business over a number of years. Now, non-current asset may be one, tangible non-current assets. Okay, non-current assets may be one, either tangible non-current assets. And when we talk about tangible non-current assets, we are saying that they are physical assets such as property, land and buildings, plant and equipment, including motor vehicles. Okay, good. So non-current assets are of two forms. You have tangible non-current assets and intangible non-current assets. Okay, the tangibles are the physical assets such as property. Okay, so a property of a business could be maybe a business has acquired land. You can see the land, you can touch the land, or they have put up a building. Now you can see the building in its physical structure, in its physical form. Okay, good. Then we have plant and equipment, including what? Motor vehicles. So these are tangible non-current assets. Now, when they talk about intangible non-current assets, we are saying that these are assets that do not have a physical existence, such as patent right, copyright, softwares. Okay, now you cannot see the software. Okay, you may see what the software can do, but the actual software you cannot feel and touch it. Do you get the point? Good. So intangible and current assets are assets that do not have a physical existence. Okay, such as patent right, copyright, trademark, among other forms. Okay, good. Good. Now to some key terminologies. Okay, good. Now you can see that we are talking about non-current assets. We say tangible, intangible. Okay, at times you hear property, plant, and equipment. Okay, good. In those of us who did business in SS, we will look at asset as either fixed assets or tangible fixed asset or what intangible. Okay, good. So now we are saying that it is called non-current asset and what current assets. So assets are either current or what non-what current. Do you get the point? Good, good. So again, what is PP? What is PP? Good. Now, property, plant, and equipment are tangible items. So another name of fixed asset or fixed tangible assets, okay, is what? Property, plant, and equipment. So when you hear property, plant, and equipment, then it means you are talking about what? Tangible fixed assets, okay, or what is called non-current assets. Because if the asset is not current, then it's non-current. You get a point? Good. So property, plant, and equipment. Now, property, plant, and equipment are tangible items that, one, are held for use in the production or supply of goods or services, for rental to others, or for administrative what purposes. Okay, we are saying that a tangible asset of a business are those assets that are held for use in the production or supply of goods or services, for rental to others, or for administrative purposes, and are expected to be used during more than one period. And they are expected to be used during what? More than one what period. Okay, good. So property, plant, and equipment are, one, tangible assets that are held for use in the production or supply of goods or services, for rental to others, or for administrative purposes. And those assets are expected to be used during more than one what period. Good. So, for example, a business asset, a business building, okay, may be used for production, or may be used for supply of services, or for rental, or for administrative purpose. So any of this, okay, if a business asset is used for any of this, whether for production or for the supply of goods or services, for example, if a business has a delivery van, that delivery van is an asset of the business. That delivery van may be used in distributing the company's product or for rendering the services of the organization. Okay, good. A business can also rent its assets, and it still qualifies as what? A property, plant, and equipment. Maybe a business may have maybe a huge conference room which they can use it for what? Rental purposes. Okay, good. It qualifies as what? A property, plant, and equipment, or a tangible fixed what? Assets. Okay, good. Now we are saying that these assets are also expected to be used during more than one what period. For example, no company will go and buy maybe a motor vehicle and expect that they will use the motor vehicle for just a year. You get the point. Provided the asset is in good shape and bought and purchased, okay, or acquired newly, okay. Now it's expected that that asset will be used for some number of years. Okay, the business building cannot be used for a year. Okay, good. So they are expected to be used during more than one what period. That is PPE. That is property, plant, and equipment. We are seeing that they are tangible items that are held for use in the production or the supply of goods or services, for rental or for administrative purposes. Good. Now, property, plant, and equipment, therefore, does not include an item to be sold or consumed in the ordinary course of business. So when we talk about property, plant, and equipment, they do not include items that are purchased to be sold or to be consumed in the ordinary course of business. Okay, such items are regarded as inventories in accordance with IAS 2 what? Inventories. So if a particular business asset is acquired to be sold or to be consumed in the ordinary course of business, we are saying that it cannot be classed as a tangible asset, or it cannot be classed as a property, plant, and equipment. Those assets, if they are purchased with the right intention of selling or to be consumed in the production process, then they are seen as what? Inventories, and that will be accounted for under IAS what? 2. Good, good. Now, when we talk about cost of an asset, what do we mean? Now, cost of an asset is the amount of cash or cash equivalents paid or the fair value of other consideration given to acquire an asset at the time of its acquisition or construction, or where applicable, the amount attributed to the asset when initially recognized in accordance with the specific requirement of what other IFRS. Example is IFRS to share-based payment. So when we talk about cost of an asset, we're looking at the amount of cash or cash equivalent paid or the fair value of other consideration given to acquire an asset at the time of its acquisition or what construction. Okay, so once, for example, a business makes up its mind to go and acquire an asset, okay, it is either they are going to pay cash, or maybe they may do some form of payment in kind. Okay, so that's why I say that it is the amount of cash or cash equivalents. Okay, we may maybe have some investment somewhere, and maybe may tend to use the investment to pay for the item. It's a cash equivalent. Okay, cash equivalent are term deposits that are readily convertible to cash. Okay, good. So if I have 3-month investment or a 3-month fixed deposit, and I'm going to buy something, and I don't have physical cash, and therefore I intend to pay using that fixed deposit certificate or documentation, which qualifies as a cash equivalent. You get a point. Good. So we are looking at cash or cash equivalents, or the fair value of other consideration. Maybe you can do an exchange. Okay, good. And so the value of the item that you are exchanging for the asset becomes the cost of that asset. So it's the amount of cash or cash equivalents paid or the fair value of other consideration given to acquire the assets at the time of its acquisition or construction. Okay, good. So that is the cost of an asset. When we talk about fair value is the amount for which an asset could be exchanged between knowledgeable willing parties in an arm's length transaction. So the fair value of an item is the amount for which an asset could be exchanged between knowledgeable willing parties in an arm's length transaction. So, for example, if I have this phone, okay, all right, good. If I happen to sell it to someone, okay, then we are saying that the fair value of that asset, okay, is the amount for which I can exchange that asset between what knowledgeable willing parties. Knowledgeable because both parties to the transaction have a fair idea of how much that kind of phone is selling on the market, and both are willing to do the exchange. Okay, good. So we all have information about the assets. Okay, and therefore, when that transaction goes through, nobody should benefit from the other. It is fair in the sense that it's the amount, fair value is the amount for which an asset could be exchanged between knowledgeable willing parties in an arm's length transaction, meaning that each player to the transaction has equal information. And when the transaction goes through, no one should benefit from the other. You get it? It is fair. Good. When we talk about recoverable amount, it's the higher of an asset's fair value, less cost to sell, and its value in use. When we talk about the recoverable amount of an asset, we are saying that it is the higher of the asset fair value, less cost to sell, and the value in use. Okay, good. Recoverable amount is part of the net carrying amount of an asset that the enterprise can recover from the future use of the asset, including its net realizable value of disposal. Okay, good. Maybe later in our discussions, we'll break the recoverable amount a bit down so that you have an appreciation and understanding of that. Okay, good. But not to worry. When you talk about carrying amount of an asset, the carrying amount of an asset is the amount at which an asset is recognized after deducting any accumulated depreciation and accumulated impairment losses. So the carrying amount of an asset, ordinarily, if there is no impairment of that asset, okay, it's the cost of the asset minus depreciation. Okay, the carrying amount, or what is normally referred to as the net book value. the net book value. So the carrying amount of an asset is the amount at which an asset is recognized after deducting any accumulated depreciation and accumulated impairment of losses. Good. The depreciable amount of an asset is the cost of an asset or other amount substituted for cost less its residual value. Okay, the depreciable amount of an asset is the cost of an asset or other amount substituted for cost less its residual value. So if you have an asset costing 100,000 and it has a residual value of 20,000, that is the value you obtain after selling the assets. Okay, that's a scrap value. Good. Or the value you can obtain from the asset after its useful life. Okay, good. If you deduct this 20,000 from the 100,000, you get what? 80,000. So the 80,000 is the amount available to be depreciated. So that's the depreciable amount. That is the cost of an asset or other amount substituted for cost less its residual value. Good. Good. Then what is depreciation? Now, depreciation is the systematic allocation of the depreciable amount of an asset over its useful life. Okay, so an asset when acquired, we will estimate that this asset can go over 5 years. You can use this asset for 10 years. Okay, and therefore, if you are looking at the straight line method of depreciation, then we are saying that the cost divided by 10 years should give us the value or the depreciation every year. We are trying to spread the cost over the asset's useful life. We don't want to expense the total amount. Okay, it's just the year in which the asset is acquired. We are saying that it may be a huge blow to the company's performance, and therefore, since the asset will not be used for just a year, we should find a way to spread the costs over its useful life. So that is the depreciation. That's a method of allocating the depreciable amount of an asset over its useful life. Good. You have terms like entity-specific value. Entity-specific value. That one refers to, or when we talk about entity-specific value, we are saying that it's the present value of the cash flows an entity expects to arise from the continued use of an asset and from its disposal at the end of its useful life, or expect to incur when selling a liability. So entity-specific value is the present value of the cash flows an entity expects to arise from the continued use of an asset and from its disposal at the end of its useful life, or the amount the entity expects to incur when settling a liability. That is entity-specific value. Good. Then we talk about impairment loss. Now, we say an asset is impaired when the carrying amount of that asset exceeds its recoverable amount. Okay, so if I have an asset, okay, now maybe I've used this phone for say 5 years or 2 years. Okay, I bought this phone for, let's say, 2,000 Ghana cedis. Okay, now I've used it for 2 years. Now, maybe now, because I've used it, maybe now the value has come down, and so maybe for 2,000, I can sell it for say 1,000, and somebody offers to pay me 500. Okay, to me, the carrying value or the value that I expect is to get at least 1,000 for this one. So when somebody offers to pay 500 is the recoverable, how much you can recover. Okay, good. Therefore, you can see that my 1,000 and 500, there is a difference. Okay, so if the carrying value exceeds the recoverable amount, then the difference is what is referred to as what impairment loss. So if I want to sell it for 1,000, somebody give me 500. Now the 500 becomes a recoverable amount, how much I can recover. Okay, and so when the 500 is accepted, it means that I've lost 500. The 500 is what is termed as what impairment loss. So impairment loss is the amount by which the carrying amount of an asset exceeds its recoverable amount. Good. Then we have what is called residual value. Now the residual value of an asset is the estimated amount that an entity would currently obtain from disposal of the assets after deducting the estimated cost of the disposal. If the assets were already of the age and in the condition expected at the end of its useful life. So residual value of an asset is the amount the business expects to obtain from sale of the asset at the end of the asset's useful life. Okay, and that value we need to kick out or deduct any cost that will be incurred in selling the assets. Okay, good, good. Useful life of an asset. Useful life of an asset is the period over which an asset is expected to be available for use by an entity. When we talk about useful life of an asset, we are looking at the period over which an asset is expected to be available for use by an entity, or the number of production or similar units expected to be obtained from the asset by an entity. The number of production or similar units expected to be obtained from the asset by the entity. Okay, good. Now we've looked at what non-current assets are, and we have also looked at the due terminology for non-current assets or for fixed assets, which is what property, plant, and equipment. Okay, and we have come to the conclusion that we come to know that when we talk about property, plant, and equipment, or PPE, they are what tangible items that are held for the business for production, for supply of goods or services, for rental to others, or for administrative purpose, and those assets are expected to be used for more than one accounting period. Good. And we've also looked at the fact that certain items of property, plant, and equipment may be bought, but which are used for which are for sale or that are consumed in the normal production process. Okay, we are saying that those kind of assets are classed as what inventories. Okay, those class of assets are classed as what inventories. Okay, good. Now we've looked at other key terms as well. Good. Now quickly, let's take an example. Let's take this question, brief one. Now, One Touch Limited is a real estate company selling land and self-constructed buildings. The entity had the following at the end of the reporting period. That is the 1st December 2018. Now we have motor vehicles, we have buildings here to be sold, we have administrative building, we have factory building, and we have cement. Okay, and we have cement. Now we are expected to determine the value of what, calculate the value of the property, plant, and what equipment. Calculate the value of the property, plant, and what equipment. So One Touch Limited is a real estate company, so we must note that one carefully. The company is a real estate company, or it is into real estate. Now, selling land and self-constructed buildings. The entity had the following at the end of the reporting period: motor vehicles, buildings here to be sold, administrative building, factory building, and they have cement. Required, calculate the value of property, plant, and equipment of what One Touch Limited. So how do we determine that? Now, motor vehicles, man, if the real estate company makes use of motor vehicles, it is used for administrative purposes, or maybe when they are doing their constructions, they have vehicles that they send to site and all that. That is a business asset. Buildings here to be sold, because they are into real estate, and they do what, sell the buildings. Now the building is their inventory, so we cannot class that as a PPE. You get the point? The business in which they are into is to the sale of buildings. Good. Administrative building, obviously that is where all administrative activities take place, and therefore that could be seen as a business asset. So it's a part of PPE. The administrative building is part of PPE. Good. The factory building, okay, good. Factory building is also part of the PPE of the business, the real estate company. Cement, because they are into construction, cement may be one of the items of inventory. Okay, good. So you have to calculate the value of the PPE. Good. So let's see. Good. All right. So we are to determine the value of property, plant, and equipment. So we have One Touch Limited. We have property. We have property, plant, and equipment. Okay. So one will be our motor vehicles. Two will be the administrative building. So motor vehicle is 12,000. Administrative building is 19,000. Then we have factory building, also 21,000. Okay, good. So this three becomes the property, plant, and equipment in the business. So we have 12,000 plus 19,000 plus 21,000. And that gives us 52,000. That gives us 52,000. So that is the property, plant, and equipment of the business. Okay, good, good, good. Let's carry on. Because it's just to set the ball rolling. Okay, good. So let's move on. All right, good. Now let's look at recognition criteria. The recognition criteria. Now, don't forget that when we're looking at the introductory aspect to financial accounting, we spoke about recognition of assets and liabilities. And we said that before an item will be recognized in the financial statement, it needs to meet the definition of one of the elements of a financial statement, that is assets, liabilities, equity, liability. Okay, good. Income and what expense. That item must meet the definition of one of them before that item can be included in the financials of what a particular entity. Good. Now, so when we have PP, okay, certain preconditions must be met before if an item will be recorded in the financial statement as an asset. Okay, we must see certain things. Certain things must be present before that item can be recorded as what? As a PP. Good. So we are saying that in this context, okay, recognition simply means incorporation of the item in the business's account, in this case as a non-current asset. So when we talk about recognition, we are looking at simply incorporating an item in the business's account, in this case as a non-current asset. Now, the recognition of property, plant, and equipment depends on two criteria. Okay, the recognition of property, plant, and equipment depends on two criteria. One, An item must be recognized as a property, plant, and equipment to the extent that, one, it is probable that future economic benefits are expected. Okay, future economic benefits are associated with the assets. Okay, or the future economic benefits associated with the assets will flow to the what? The entity. It is probable that future economic benefits associated with the assets will flow to the entity. And two, the cost of the assets to the entity can be measured what? Reliably. So one, an item is recognized as a property, plant, and equipment to the extent of one, it is probable that the future economic benefit associated with that item will flow to the what? The entity. And the cost of that item to the entity can be measured what? Reliably. Okay, so this is when we have already come to the conclusion that now that item is an asset because it meets the definition of what an asset is. Because an asset is a resource owned and controlled by an entity as a result of a past event and from which future economic benefit will flow to the entity. So having met the definition of an element of financial statement, i.e., that is an asset, we are saying that it should be recognized to the extent that it is probable that future economic benefits associated with that asset will flow to the what? The entity. And that the cost of the asset to the business can be measured what? Reliably. So for example, the business has constructed a building. Now, the business stands to make use of that building in its business. Now, that building will facilitate or aid in the business of the operations of the business. Okay, so you can see that future economic, because as you make use of the asset, it benefits you in so many ways. You don't tend to go and pay rent to anybody. You make use or you run your business from that end. Okay, and to future benefits will flow to the entity. Okay, again, the cost of the asset, because it was a constructed building. Now you know the amount of money that went into it. You should be able to estimate and be able to put value to the asset. Do you get me? So if it's a motor vehicle that you want to acquire, now you go, the seller will give you the value of the vehicle and you pay for it. Now the vehicle maybe is used for administrative purposes or to aid and facilitate in the easy movement. Okay. Now it's expected as the asset is used. Okay. The benefit that is associated, that is the making use of, say, a motor vehicle will make sure that the business operations are done within a reasonable time. Okay, as opposed to where the business does not have any asset and therefore would have to commute from one place to the other. Now that will delay. There will be delays in delivery. Okay, so again, one, to recognize an item as a PPE. Now it should be probable that the value or the future benefit associated with that asset will come to the entity or flow to the entity. And again, you should be able to value that asset. Put a value to it. So the initial criteria is that it should be probable that future economic benefits associated with the asset will flow to the entity. And two, the cost of that asset can be measured what? Reliably. Wait. Now let's talk about initial measurement. If an item is acquired, okay, how should we measure it? So you are saying that once an item of property, plant, and equipment qualifies for recognition as an asset, it will initially be measured at cost. Okay, once an item of property, plant, and equipment qualifies for recognition, that asset will initially be measured at what? At cost. So the initial measurement of an asset is at what? At cost. That's how much did the company incur, or how much did the company part way with to acquire that asset. So it will initially be measured at what? At cost. Good. Now, so what constitutes the cost of an asset? So here we look at what? The component of cost. Now, the standard lists the component of the cost of an item of property, plant, and equipment as follows. So the component of cost, okay, according to IAS 16, is one, the purchased price. The purchased price, less any trade discount or what? Rebates. So the standard says that the cost of an asset includes the purchase price, less any trade discount or rebates. So if we bought an asset and we got a discount for it, then in measuring the cost, we pick the purchase price and less that discount from it. Now, import duties and non-refundable purchase taxes. If the asset was imported and therefore we paid some form of import duties or some taxes that are non-refundable, now we are saying that that should also be included in the cost of the item. Okay, good. 3, directly attributable costs of bringing the asset to working condition for its intended use. Directly attributable cost of bringing the asset to working condition for its intended use. Okay, good. So what are some of the examples of directly attributable costs or direct attributable costs? Now they include: 1, cost of employee benefits as defined in IAS 19 employee benefits arising directly from the construction or acquisition of the item of property, plant, and equipment. Cost of site preparation. Maybe you've got a plant. That plant needs to be installed. Now, we are saying that as part of the cost, the amount that we will incur in preparing the site on which the plant will be installed constitutes part of the cost of the assets. Okay, good. So then initial delivering and handling cost. When an asset, a plant is purchased, and therefore maybe the asset needs to be transported from the seller's point to the buyer's point, or to the business premises. Okay, to the business premises. They are saying that the initial handling, initial delivering and handling costs constitute a directly attributable cost. Then we talk about installation and assembly costs. The cost that will be incurred in installing that plant should be considered as part of the cost of the asset. 4, cost of testing whether the asset is functioning properly after deducting the net proceeds from selling any items produced while bringing the asset to the location and condition, such as samples produced when testing equipment. Okay, so the cost of testing whether the asset is functioning properly, okay, that cost should be included in the cost of the asset. Then we talk about professional fees. Professional fees, for example, architects and engineers. So if the plant needs to be installed by some form of engineers, okay, good. We need to include that cost as well. Okay, good. Then initial estimate of the unavoidable cost of dismantling and removing the assets and restoring the site on which it is located. Okay, so initial estimate of the unavoidable cost of dismantling and removing the assets and restoring the site on which it is located. So if it's a factory, plants or equipment that needs to be installed, and at the end of the day or at the end of the business cycle, that asset needs to be dismantled, then we are saying that we should estimate that cost, unavoidable cost of dismantling and removing the assets and restoring the site on which that asset was located. Okay, we must estimate it and include it in the cost now. Okay, as opposed to wait till the time comes when you have to dismantle. No. So the cost of an asset includes the purchase price, less any trade discount, import duties and non-refundable taxes, directly attributable costs. Okay, and we've looked at a number of the directly attributable costs. So cost of employee benefits that are directly associated with construction or acquisition of item of equipment, cost of site preparation, initial delivery and handling costs, installation and assembly costs, cost of testing the assets to find out whether the asset is functioning properly, professional fees such as fees paid to architects and engineers, and initial estimate of the unavoidable cost of dismantling and removing the asset and restoring the site on which it is located. Okay. So that is the cost. Now there are other costs. There are other costs that are excluded, that the standard specifically lists as cannot be included or cannot be considered as cost of an asset. So exclusion from cost. Exclusion from cost. Good. Now the following costs will not be part of the cost of property, plant, and equipment unless they can be attributed directly to the assets acquisition or bringing it into its working condition. 1. Administration and other general overhead costs. Administration and other general overhead costs. Startup and similar pre-production costs. Setup and similar pre-production costs. Initial operating losses before the assets reaches planned performance. Initial operating losses before the asset reaches planned performance. Now, cost of opening a new facility. The cost of opening a new facility. Cost of introducing a new product or service, that is including cost of advertising and promotional activities. No. Cost of conducting business in a new location or with a new class of customer, including cost of staff or training. No, we cannot include it as cost of an asset. Okay, cost incurred while an item capable of operating in the manner intended by management has yet to be brought into use or is operated at less than full capacity. Good. And cost of relocating or reorganizing part or all of the entity's operations. Good. Then income earned and expenses incurred in respect of incidental operations occurring before or during the construction or development activities. An example is income earned during using a building site as a car park till construction starts. Okay, good. This is because incidental operations are not necessary to bring an item to the location condition for it to be capable of operating in the manner intended by management. All of this will be recognized in the profit or loss account rather than capitalizing it as an asset. I hope you're together. Good. So let's pick some example. And see how we will go about it. Let's pick some examples. Good. So quickly, let's read through our question. So example 2, One Touch Limited is installing a new plant at its production facility. It has incurred these costs. 1. Cost of the plant, that is cost per supplies invoice plus taxes, 2.5 million. Initial delivery and handling cost, 200,000. Cost of site preparation, 600,000. Consultants used for advice on the acquisition of the plant, 700,000. Interest charges paid to supplier of the plant for deferred credits, 200,000. Estimated dismantling cost to be incurred after 7 years, 300,000. Operating losses before commercial production, 400,000. Good. So we are saying that advise One Touch on the cost that can be capitalized in accordance with IAS 16. Okay, advice. So now we are looking at those costs that can be classed, okay, as the cost of DP. Don't forget, we said that it includes the purchase price, Okay. Then directly attributable costs. Okay. Non-refundable purchase taxes. Okay. Then the initial estimates of the cost of dismantling and restoring the site on which the property is to be what the item of asset, the item of PPE is to be what located. Okay, good. So let's look at this. So value of PPE, value of PPE. So you have one touch limited. So value of PPE. So one, we have cost of the plant. So that is included. So cost of plant of 2.5 million needs to be captured. We have cost of site preparation. Cost of site preparation. Cost of site preparation, which is 200,000, should be included. We have consultants used for advice on the acquisition of the plant. So that's the professional fees. Professional fees. Then we have interest charges paid to supplier of the plant for deferred credits, 200,000. I don't think we saw any of this. Okay, good. So we can't class this as part of the cost. Then estimated dismantling costs to be incurred after 7 years. So dismantling cost is part. Dismantling cost is part. Then that is 300,000. Okay, that is 300,000. Initial delivery. Oops. Hold on. The site preparation, cost of site preparation is 600,000. Is 600,000. Professional fee 700,000. Dismantling cost is 300,000. Then initial delivery and handling cost. Initial delivery and handling cost. That is 200,000. Good, good. So let's add up. So you have 2.5 plus 600,000 plus 700,000 plus 300 plus 200. That gives us 4.3 million. So that amount, that one touch should capitalize as the value of PPE in line with IS 16 should be what? 4.3 million. All the other costs should be what? Expense, as they do not meet the criteria for recognizing an item of what? PPE. Okay, good, good, good. So that will be the value of one touch PPE. Okay, because spoke about the costs, less any trade discount, non-refundable purchase taxes, directly attributable costs, of which so many items are itemized, then the initial cost of dismantling and restoring the site on which the property is to be located. Good, good. Now let's look at the next one and see whether we can do some justice to it. One Touch Limited incurred the following cost in 2016 in the design and construction of a new office building over a 9-month period during 2016. We have feasibility study. We have architect fees. We have site clearance by external demolition professionals. We have construction materials. We have cost of own inventories used in the construction, and that we have been given the net realizable value if sold outside the company to be 24,000, and we have the value to the construction, which is 30,000. We have internal construction staff salaries during period of construction. We have external contractor costs. We have income from renting out part of sites as storage depot. That's a storage depot. Power during early phase of the construction. Okay, good. So the cost build up has been given. Now we are saying that required in accordance with IES 16, property, plant, and equipment, calculates the amount that should be capitalized as property in the financial statement for the year 31st December 2016. So now, so many costs have been given. We have feasibility, we have architects, we have site clearance, we have construction materials, we have cost of own inventories and the construction. We have external construction staff salaries during the period of construction. Of external contractors' costs and income from renting out part of the sites as storage depot during early phase of what construction. So how do we go about this? So here, one touch is putting up a building. Okay, one touch is putting up a building. Okay, good. So how do we determine that? So we have One Touch Limited. We have One Touch Limited. Okay, good. So feasibility study. Now, the feasibility study cannot be included. Why? Because, for example, now you can undertake the feasibility study and the construction may or may not come on. Okay, good. So we cannot include such a cost into the value of the PP. Okay, good. Again, we have architect fees. Okay, good. And we saw professional fees as part of the cost, right? So the fees of the architect needs to be included. Good. So you have the architect's fees. And the architect's fees of 100 and 3 zeros on top. We have site clearance. That also needs to be included. There's a site preparation cost of what? 80,000. Good. We have construction materials that needs to be included. Construction materials of 600. Okay. Then we have cost of own inventories used in the construction. Net realizable value if sold outside the company is 24,000. But now it costs the business 30. And we shouldn't forget that inventories are valued at the lower of costs and the net realizable value, whichever is what we pick it. Okay, good. It's valued at the lower, of course, and the realizable value. So you need to compare the cost against the realizable value. Whichever is lower, you pick it as the value of the inventory. And here is a construction that is being done. Okay, we are putting up a building. So if the company has some inventories in store, okay, that inventory needs to be considered because that inventory will go into the building. Do you get the point? And therefore, we have to value it properly. And since we have been given the cost as against the realizable value, we need to compare the two and pick the lower one because that is the basis on which inventories are what valued. Okay, good. So here, the cost of own inventories, cost of own inventory, cost of own inventories. So that becomes 24 because 24 is lower than the cost of 30. And we know that inventory should be valued at the lower, of course, and the net of what value. Good. Then we have internal construction staff salary during the period of construction. Okay. Internal construction staff salaries during the period of construction. That is 360. Then we have the external contractors cost of what 2,400. Okay, good. Then income from renting part of good. So in the case of the internal construction staff salary, okay, now that is a typical part of what administrative cost, okay, because they are part of the company, okay. So their cost is not cost that is directly attributed to the construction of the building. Now, whether they work or not, they will be paid, okay, because they are staff of the company. Okay, good. Then we have external contractor costs. Okay, now you can see that these people have been specifically contracted to undertake this what assignment. Okay, they have been contracted to undertake this assignment. So we cannot exclude that cost. That is directly attributed. Okay, so we have the external contractors. External contractor costs. That is what 2.4. Good. Good. All right. So this will constitute the cost of the what the PPE. Good. So let's see. We have 100 plus 80 plus 600 plus 24 plus 2,400. Good. So that gives us 3,204. Okay, 3,204. So this constitutes the item of what? See. Sorry. So One Touch Limited incurred the following costs in 2016 in the design and construction of a new office building. Okay, so they designed it and they constructed. Okay, so feasibility, architect, site preparation, cost of inventories used and preparation, internal construction staff salary during the period. Okay, good, good. So take note of this. Now, this cost was incurred during the period of construction. During the period of construction, that has been stressed. Okay, since the cost was incurred during the period of the construction of this building, it's a directly attributable cost. Okay, good. So sorry, that's a directly attributable cost. We'll take note of it. So cost of own inventories has been captured. Then internal construction cost, internal construction staff cost, that is 360. Okay, good. Then we have external construction costs of 2.4. Good. So I pick my calculator of 100 plus 80 plus 600 plus 24 plus 360 plus 2,400. Good. That is 3,564. Good. So that is the value of what? The PP. That's the value of the PP. Good. Good. So basically what we are doing here is to identify what? The cost of PP. Okay, so you need to take note of that. One, we spoke about the purchase price less any trade discount, then import duties and non-refundable taxes, and directly attributable costs. That's costs that are incurred to bring the asset to its present location and condition for it to be operated in the manner intended by management. That needs to be noted. Okay, and any initial cost of dismantling and restoring the site on which that item of property will be installed. Okay, so take note of this element of cost. And again, have a fair idea or an understanding of costs that are excluded. Okay, good. So that is basically what we are looking at here. Good. So now let's continue. So at least we've looked at the initial recognition of an asset. We said that the initial recognition of an asset or asset should be recognized to the extent that it is probable that future economic benefits associated with the asset will flow to the entity, and that the value of that asset to the entity can be measured reliably. So it's for example what you are doing. You're looking at the value to be given an item. Okay, good. So you need to know that. Then we said that an item of property equipment is initially recognized at cost, and we went ahead to look at the component of cost. Okay, of which we've looked at some illustrations. Okay, good. So please take note of these things. Take note of these things. It's very important. Good. Okay. Good. So that's a question 4. You try that on your own. Let's look at self-constructed assets. There are times that the assets may not be purchased, but the business may construct it. Even in some of our examples, we looked at some. Okay. Now, in the case of self-constructed costs, the same principles are applied as for acquired assets. If the entity makes similar assets during the normal course of business for sale externally, then the cost of the asset will be the cost of its production and the IES2, that's inventories. This also means that abnormal costs, wasted material, labor, and other resources are excluded from cost of the asset. An example of a self-constructed asset is when a building company builds its own head office. So that's a self-constructed cost or a self-constructed assets. So we've already looked at some of the examples. Okay, good. So let's see. Boache Limited is a real estate company. On 1st January 2018, the company decided to construct an administrative building and incur the following costs: feasibility study, land, water, cost of relocating staff, material cost, labor cost, cost of roofing. There was a leakage in the water tank, and that resulted in an abnormal amount of wastage amounting to this. Boache Limited has realized that it's incurred certain incidental or miscellaneous expenses. However, the exact amount could not be established. It was certainly not below 11,500, but could be as much as 19,500. So you have to calculate the initial amount to be recognized as at 1st January 2018 as the value of the self-constructed asset. So you have feasibility study, you have land, we have water, we have cost of relocating staff, we have material costs, we we have labor costs, and we have cost of what? Roofing. Good. And we have been given other information. We have been given other information. What are this information? Let's consider the information that has been given us. We have there was a leakage in the water tank. Okay, there was a leakage in the water tank. There was a leakage in the water tank. Any other? And that resulted in an abnormal amount of wastage amounting to 2,800. Boachi Limited has realized that it incurred certain incidental / miscellaneous expenses. However, the exact amount could not be established. It was certainly not below 11,500, but could be as much as 19,500. Okay, good, good. The initial amount to be recognized. So, which of this? We know that feasibility is out. The value of the land to be included, the water that will be used, cost of relocating staff to where. Okay, so that is out. Material cost to be included, labor cost to be included, roofing cost to be included. What of the leakage in the water tank? And that resulted in an abnormal amount of waste. Now we know that anything that results in abnormal losses, waste, those things cannot be included as part of the cost. Okay, good. Then Boachi Limited has realized that it incurred certain incidental / miscellaneous expenses. The exact amount could not be established. So there's some form of estimation here. Now we are saying that it was certainly not below 11,000, but could be as much as. Okay, so here we have to pick the upper limit. Okay, it will not be below 19, but it could be as much as 19,500. So we cap it at the 19,500. Do you get the point? Good, good. So let's look at it. So here we have the cost of the administrative building. Feasibility study is nil. Land has been given. We have the water has been given. Okay, water has been given. We have cost of relocating staff, that is not part of the cost. We have material costs, we have labor costs, we have cost of roofing, and we have miscellaneous expenses. Good. So let's look at why we excluded the feasibility study. We are saying that even though the question is under IAS 16, research costs, that feasibility study, will be treated in accordance with IAS 38. The feasibility study should not be capitalized, but expensed in accordance with Standard Interpretation Committee, that is SIC 32. Now, that requires expenditure on research or on the research phase of an internal project to be recognized as an expense when not incurred. So the research cost will be recognized as an expense. The reason why it's expense is that the feasibility could take place that will not materialize in me putting up or constructing that asset. Okay, good. That's why it is an expense. Good. Now, cost incurred for relocating staff. Now, this cost should be expensed because it is not directly in relation to the construction of the factory or making the building ready for its intended use. So we are not including it because that cost was expensed, not in direct relation to the construction of the factory or the making the building ready for its intended use. Good. Now, the miscellaneous expenses. Now, best estimate for a single amount of expense should be the highest or maximum amount. Therefore, the best estimate for the provision in relation to the miscellaneous expenses should be the 19,500. So when it comes to estimation, we are saying that the best estimate for a single amount of an expense should be the highest or the maximum amount. So here, because the question says it is let's go to reach the exact. It was certainly not below 11,500, but could be as much as. So here, use the best estimate should be the highest or the maximum amount. Okay, good, good. So that is why we use that. Good. All right. So take note of this. It's 17,500 minus 2,500. That cannot give us 17,500. So 17,500 minus 2,800. That should give us 14,700. Okay. So let me recompute. That's it's a typo. Good. So here, let's reproduce this. Okay. So we have the costs of the administrative building. So we have the land, cost of the land, which is 80,000. We have water. And I said the water should be less the amount of wastage, which is 2,800. Okay, and when we deduct 2,800 from 17,500, we get 14,700. Okay, good. We have material costs of 55,000. We have labor cost of 91. We have cost of roofing, 72. The miscellaneous expense of 19,500. Now, note that we are including the miscellaneous expense because in the footnotes we were told that it was incidental to the construction. Good. So 80,000 plus 14,700 plus 55,000 plus 91,000 plus 72,000 plus 19,500. That gives us 332,200. Okay, 332,200. Good. Good. To take notes here, the 2,800 wasn't subtracted. That's how come we got 335. So please take note of it. Okay, good. Okay. So now let's quickly look at depreciation and carrying amounts. Depreciation and carrying amount. Good. So depreciation and carrying amount. Good. So we've looked at self-constructed assets. Okay. So you can proceed. Okay, good. So if you have any questions and all those, kindly note them. Kindly note them down. In our interactive session, we'll address them. Okay, good, good. Now let's look at exchange of assets before we come to the carrying amount of assets. Now, according to IAS 16, or IAS 16 specifies that exchange of items of property, plant, and equipment, regardless of whether the assets are similar, are measured at fair value, unless the exchange transaction lacks commercial substance or the fair value of either of the asset exchange can be measured reliably. If the acquired item is not measured at fair value, its cost is measured at the carrying amount of the asset given at expenditure incurred in replacing or renewing a component of an item of property, plant, and equipment must be recognized in the carrying amount of the item. The carrying amount of the replaced or renewed component must be derecognized. Okay, as an expenditure incurred in replacing or renewing a component of an item of property, plant, or equipment must be recognized in the carrying amount of the item. The carrying amount of the replaced or renewed component must be derecognized. A similar approach is also applied when a separate component of an item of property, plant, and equipment is identified in respect of major inspection to enable the continued use of the item. So we'll look at an example of this later in our discussion, because we'll blend it with other questions. Okay, good. So let me move on straight to depreciation and carrying amount of an asset. Now, definition of depreciation. I think we looked at it in the definition of other key terminologies. Good, but let's look at it briefly, or expatiate on it briefly. Okay, good. Now, depreciation is the method of spreading the depreciable amount of a non-current asset over its expected useful life, that is economic life, so that an appropriate portion of the cost is charged in each accounting period. Can't go and buy a plant, say 1 million, and say that you are recognizing that an expense. No, it's a huge capital expenditure. Okay, and therefore needs to be spread over the useful life of that asset. Good. 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 Now, let's look at some specific definitions from the standard. Okay, good. Now, the standard defines depreciation as the systematic allocation of the depreciable amount of an asset over its useful life. The systematic allocation of the depreciable amount of an asset over its useful life. So what is depreciable amount? Now, the standard again defines depreciable amount of an asset as the cost of an asset or its revalued amount. The cost of an asset or its revalued amount in cases where a non-current asset is revalued during its life, less its residual value. So if an asset's cost is given you and the residual value or the scrap value is also given, we are saying that the depreciable amount represents the difference between the cost and the residual value. What is residual value? Now, residual value is the expected disposal value of the assets after deducting disposal costs at the end of its expected useful life. So the amount that will be realized from the sale of the asset at the end of its useful life, less any cost to sell. So that's the residual value or the scrap value of the asset. Okay, good, good. Now, useful life is the period over which the asset is expected to be available for use by the business entity. Now, we are talking about depreciation. At what point should a business start depreciating an asset that it has acquired? Now, we are saying that commencement of depreciation must be charged from the date the asset is available for use. Note, you should start charging depreciation on an item of property, plant, and equipment when that asset is available for use. That is, it is capable of operating in the manner intended by management. This may be earlier than the date it is actually brought into use. For example, when staff need to be trained to use it, depreciation is continued even if the asset is idle. So as soon as the asset is available for use, we are saying that depreciation should start. NB, depreciation should be charged as an expense in the statement of profit or loss each year over the life of the asset. And depreciation of new assets commences from the date the asset is available for use. That is just to stress that point. Okay, good, good, good. Most non-current assets must be depreciated, although there are some exceptions to this rule. For example, land is not depreciated because it has an indefinite useful life. You cannot assign useful life to land. Okay, so it's not a depreciable asset. Okay, good, good, good. So we are looking at depreciation and the carrying amount of an asset. We've looked at what depreciation is. We've looked at the depreciable amount of an asset. That is the cost of an asset less its residual value. We've looked at what residual value is as the expected disposal value of an asset. That is after deducting the disposal cost at the end of the asset's useful life. Good. And useful life here simply refers to the period over which the asset is expected to be available for use by the business or entity. And we said that depreciation should start as soon as an asset is available for use. So even if there are things that are being done in a bid to make use of the asset, that still should not delay, or that should not delay the commencement of depreciation. Good. So let's look at this example. An asset costs 100,000 and has an expected useful life of 10 years. The purchaser intends to use the asset for 6 years, at which point the expected residual value will be 40,000. What is the depreciable amount? What is the depreciable amount? Good. So let's look at the depreciable amount. So we say that an asset costs 100,000 and has an expected useful life of 10 years. The purchaser intends to use the asset for 6 years, at which point the expected residual value will be 40,000. What is the depreciable amount? Good. So we know that depreciable amount of an asset, the depreciable amount of an asset is the cost of the assets, or its revalued amount in the case where a non-current asset is revalued during its life, less its residual value. So in this question, do we have the cost or the revalue? We have the cost. And again, we have been given the residual value. So the depreciable amount here, the depreciable amount is equals to the cost, which is 100,000, minus the residual value of 40,000. So therefore, the depreciable amount is what? 60,000 Ghana cedis. Right? Good. So that's how you go about it. That's how you go about it. So let's look at methods of calculating depreciation. The methods of calculating depreciation. Okay, good. Now, basically at this level, okay, we will consider two methods of calculating depreciation. Those are the straight line method and the reducing balance method. Good. So there we have the straight line method of calculating depreciation and the reducing balance of calculating. There are other methods. That's what I'm saying. At this point or at this level, we'll be considering just these two. I know those of us who did business in SS, we looked at several other methods: production unit method, machine hours, among others. Some of the years they get method, among others. Good. But the most commonly used ones are the straight line method and the reducing balance method. Okay. Good. So when we talk about the straight line method of depreciation, we are saying that where the depreciable amount is charged in equal amount to each reporting period over the expected useful life of the asset. Now, this is the most common method in practice and the easiest to calculate. Okay. So the straight line method of depreciation is where the depreciable amount is charged in equal amounts to each reporting period over the expected useful life of the asset. And that is the commonest method in practice. The formula for determining the depreciation charge for the year is the cost of the assets minus the expected residual value divided by the estimated useful life of the asset. Now, note, with the straight line method, the annual depreciation charge is the same for each full financial year over the life of the assets. Now, unless the asset is subsequently revalued during its life. Okay, so let's look at some examples. How do we determine that we are saying that it's a cost less residual value over the expected useful life? Okay, good. There are also instances where they will give you the rates of depreciation. See, if the asset is depreciated on straight line is at 10% or 20% or 30%. Okay, good. So let's look at this. Now, a machine costs 500,000. It has an estimated economic life of 5 years and an expected residual value of 50,000 at the end of that time. Determine the annual depreciation charge. Determine the annual depreciation charge. So let's look at this. Let's look at this. All right. All right. Now, a machine costs 500,000. It has an estimated life of 5 years and an expected residual value of 50,000 at the end of. Determine the annual depreciation charge. So, annual good. The annual depreciation charge will be equal to the cost of the assets, which is 500,000, minus 50,000, all over the useful life of the asset, which is what? 5 years. Okay, good. So this gives us 450 divided by 5. And that gives us 450 divided by 5. That gives us 90,000 Ghana cedis each year. Okay, good. Now let's look at example 2. A plant costs 300,000. It has an estimated economic life of 5 years. It is expected that the plant will have a zero scrap value at the end of its useful life. The plant was bought on 1st September, and the company has a 31st December year end. Determine the depreciation charge. Okay. Good. So now, in this case, the depreciation charge charge. Now we know the cost to be what? 300. The scrap value is 0, and it's depreciable over what? 5 years. But here you can see that the asset was acquired on 1st September and they have a 31st December year end. So from 1st September, so we have September, October, November, December. Okay, that is what 4 months from September 1st. So September, October, November, December. That's 4 months. So this needs to be multiplied by what? 4 on what? On 12. Okay, good. So we have the whole of this round brackets. Okay, so we have 300,000. So this gives us 300,000 divided by 5 times 4 and 12. Okay, so this gives us 300,000 divided by 5. Okay, so that is 60,000. That will be for the full year. I want 4 months depreciation. So times 4 divided by 12. And that gives us 20,000. That gives us 20,000. I'll be out together. Great, great, great. Now let's move on. Let's move on. Now, depreciation as a percentage of cost. So there are, as I mentioned earlier, there are instances where the rate of depreciation will be given you. Okay, and then when the rate of depreciation is given, then you have to just apply the rates on the cost of the asset or the rates on the depreciable amount of the asset. Okay, good. So another way of stating straight line depreciation, another way of stating the straight line depreciation is to try and expand this. Now, another way of stating straight line depreciation is to express the annual depreciation charge as a percentage of the cost of the what? The asset. As a percentage of the cost is to express the annual depreciation as a percentage of the cost of the asset. For instance, suppose that an asset has an expected life of 10 years and 0 residual value. If the straight line depreciation is used, the annual depreciation charge will be 10% of the cost of the asset. Similarly, if the non-current asset has an expected life of 6 years and the residual value equal to 10% of its cost, straight line depreciation will be 10%, will be 15% of cost each year. That is, the cost will be equated to 100% minus the 10% as the residual value. Then you divide by the 6 years to get your rate. Okay, to get your rates. That's how I'm getting 15. So the total cost of the asset is equivalent to 100%. And they are saying that the residual value is 10%. So 10% of 100 is 10. Okay, so 100 minus 10 divided by 100 minus 10 divided by 6. Okay, that's the number of years to get the rate. So that gives 15% of cost each year. Okay, so there are instances where under the straight line method of depreciation, they may give you the rates of depreciation as opposed to the number of years. Again, when you are given the rates, you can still convert the rates into years. Okay, good. So let's look at something here. So for example, whenever it's given in percentage form, okay, when it's given in percentage form, what you are trying to say here is that the rate of depreciation may be given you or the number of years. Now, if the rate is given, we are saying can convert the rates into years. Okay, now the cost of the assets, cost of assets will be equated to 100. Okay, so if say they say the rate of depreciation is say 10%, okay, we can convert this rate into years. And to convert this into years, it becomes the cost of the asset, which is the equivalent of 100 divided by 10. Okay, 100% divided by 10%. Okay, and that would give us what? 10 years. Okay, so 10 years means 10%. If you are giving, say, 20%, then we are saying that the cost of the asset is equal to 100. So if 20% of it is charged every year, then to get the number of years, just divide 100 by 20%. Okay, so 100% of 20%, that gives us what? 5 years. Okay, good. So anytime you are given the rate, you can still convert it into years. And that is done by equating the cost of the asset to be equivalent to 100 and dividing it by the rate of depreciation to get it in what? In years. Okay, good. That's pretty straightforward. So let's not belabor that point. Let's move on. Good. So let's look at the reducing balance method of calculating depreciation. We are saying that the reducing balance method is a method of depreciation where the annual depreciation charge is a fixed percentage of the carrying amount of the assets at the start of the period. Okay, the reducing balance method is a method of depreciation where the annual depreciation charge is a fixed percentage of the carrying amount of the asset at the start of the period. Now the formula is depreciation charge for the year equals the carrying amount at the fixed percentage at a fixed percentage at the start of the year. Okay, the annual depreciation charge is highest in year one and lowest in the final year of the asset's economic life. Good. So let's see. A plant and equipment costs 200,000. It has an expected life of 5 years, and it is to be depreciated by the reducing balance method at the rate of 30% each year. Determine the depreciation charge each year. A plant and equipment costs 200,000. It has an expected life of 5 years and is to be depreciated by the reducing balance method at the rate of 30% each year. Determine the charge each year. Okay, so let's see. So as the name suggests, reducing. So as the depreciation charge is high the very first year, then going forward, it reduces. Okay, good. So let's see how it works. So determination of annual depreciation we have here. We have the carrying value. That's the beginning. We have the charge for the year. We are at a rate of 30%. And you have the carrying value. Carrying value at the end. say 5 years. Okay, so we have year one, the carrying amount will equate the cost, which is 200,000, and the depreciation charge is what? 30. So 200,000 times 30%, that gives us 60,000. Okay, so to get the carrying amount, it's the carrying value or the carrying amount at the beginning, which is 200,000 minus the depreciation, which is 60,000. So the carrying value at the end will be 140. Okay, good. So we come to year two, our carrying value will be 140,000. So at the end of the year, our depreciation will be based on the carrying value, which is 140 at the time of the depreciation. So 140 times 30%, that gives us 42. Okay, so 140,000 minus 42,000, that is 98,000. Okay, so year three, we have 98,000 times 30, that is 29,400. So 98,000 minus 29,400, that gives us 68,600. So that is year four, 68,600 times 30. $68,600 times 30%. That is 25,80. So 68,600. That gives us 48 and 20. So the fifth year of 48 and 20 times 30%. That is 14,406. Okay, so the carrying value at the end, 48 and 20, let's answer. That is 33,614. Good. So we have to determine the depreciation charge for each year. We said the assets has a life of 5 years. So this would be the depreciation charge for each year. So as the name suggests, it's reducing. So at the beginning of the year, so it was 6,000. It was 6,000 in year one. It came to 42, down to 29, down to 20, down to 14. So we say it is highest at the first year and lowest at the end of the year. How you get? So that's the reducing balance method. Okay, good. So the first charge is on the cost, and to calculate the subsequent one, you need to take the cost and take the depreciation from it. Then the value left, that's what you charge the depreciation on. Okay, so the subsequent period, again, if you like, the third year, for example, you have to pick the 200,000. Then you take away the first year depreciation, which is 60,000. Take away the second year depreciation, which is 42,000. So your carrying value becomes 90, just like this one, and you charge your 30% on it. So at any point in time, if you're not using this table, then you need to ask yourself, how many years depreciation have I charged so far? Okay, you need to take the accumulated depreciation from the cost before you charge the subsequent one. So for example, if I'm in year 4, for example, I'm charging depreciation for year 4. Now it means that I've calculated 3 years depreciation already. So I pick the cost of the asset here, 200,000. Then I take away or I'll deduct the 3 years depreciation I've calculated or computed earlier. So here is 60,000 minus 42,000 minus 29,400. So I get my current value of 68,600 before I charge the 4-year depreciation, which is 30% of the cost, which is 20,580. Add them together. Good. Good. Let's move on. All right. So calculating the reducing balance method. So we have a formula for determining the reducing balance rate. Okay, reducing balance reduces the cost balances down to its expected residual value or its expected useful life. By its expected useful life. This is calculated as follows. So you may use this one when you want to determine the rate. Okay, when you want to determine the rate. So you have x, which is the rate, the reducing balance percentage, and n is the expected useful what life. Okay, good. But rarely in exam, no examiner will ask you to determine the rate or the reducing balance rate, okay, or percentage. Okay, good. But just for our own understanding, just in case we are given a question that has some twist to it, and we have to determine the rate. This is what we do. Okay, good. So the formula is the 1 minus n root of the residual value over cost. Okay, good. So let's try this example so that we know, just in case we are faced with a similar situation, we know how to go about it. But as I indicated earlier, it is very rare that in exam you may be asked to determine that. Okay. So let's see. An asset costs 25,000 and has an expected residual of 5,000 at the end of its expected useful life, which is 5 years. Calculate the reducing balance percentage and determine the annual depreciation charge over the life of the assets. Good. So we have X. That's a determination of the what? Determination of reducing balance percentage. Okay, so we have X is equals to 1 minus the nth root of residual value over cost. So X is equals to 1 minus the fifth root of residual value, which is 5,000 over cost of 25,000. So this equals to 1 minus the fifth root of 5,000 divided by 25,000. That is 0.2. So you have 1 K of 0.2. So we have 1 minus 0.7248. So I have 1 minus 0.7248. And that gives me 0.2752. So multiply that by 100, and that gives us 27.52%. Or we approximate it to 28%. Okay, good. So we have 28%. All right. So now the next thing is for us to determine the annual depreciation charge. The annual depreciation charge. So let's see. We have the carrying value. Of the carrying value. Of the carrying value. So year 1, year 2, year 3, year 4, year 5. The charge is at 28%. All right. So let's see the carrying amount. About 25,000 times 28%. That is 7,000. So 25 minus 7,000. That is 18. 18 times 28%. That is 5040. Minus 5040. That's 12. 960. 960. 960 times 28. That's 3,629. So 12,960 minus 3,629. That is 9,331. So 9,331 times 28%. That is 2,617. 331 minus 2,613. 9331 minus 2613. That is 6718. So 6718 times 28%. That gives us 1,801. So 67818 minus answer 6718 minus 1881. That is 4837. Yeah, so this should have been equal to approximately 5,000 is the residual value. Okay, but because of the running offs, that's why I have this. Okay. All right. Or if you had used exactly 27.52, probably would get 5,000 exact, but if that's some running off, okay, good. So that affects the value at the end. Good. Good. So this is how the reducing balance method works. Okay. Good. Good. So let's move on. Now to accounting for non-current assets and depreciation. How do we account for non-current asset? When a non-current asset is acquired, how do we record it in the books of the entity? When at the end of the year, depreciation is charged or depreciation is computed by the organization, how do they record it in the books of the entity? Good. You are saying that the double entry for acquisition of non-current asset and depreciation is carried out using two accounts for each category of non-current assets. Good. So on acquisition of assets, it is either the company is paying cash for the acquisition, or is paying cash for the assets that they have acquired, or they are buying on credit. Now, so on acquisition, we are saying that the asset needs to be debited because they have acquired, the asset has become their own. So we are saying that debit the non-current asset account, then we credit cash or other payable account. Okay, because we have bought the assets, so the company is now owning the assets. So we debit the assets account, then we credit cash or other payable sort account. That is, if you don't pay for the asset, then it goes to payable account. Now, at the end of the year, when we charge depreciation, we are saying that depreciation is an expense, and we know that expense have debit balance. So we need to debit the depreciation expense account and credit what is called accumulated depreciation account. Now, that account is to account for the depreciation that we charge on the asset over time. Okay, that's the accumulated depreciation. So it's more of a provisional account or a provision account. Okay, so that's why on the actual charge, or when we compute the depreciation, we are saying that that is an expense. So we debit the expense account and credit the provision account. Okay, good. Just to accumulate the depreciation on that asset over that its useful life. Okay, good. Now the balance on the depreciation expense account is taken to the statement of profit or loss as an expense for the period. So the depreciation charge for the year, okay, is expensed in the statement of profit or loss. That is, at the end of the year, the entity is preparing its account. The amount of depreciation that the entity has been charged on their assets should be treated as what? As an expense. Okay, good, good. The accumulated depreciation account contains all of the depreciation recognized to date. When the final statement of financial position is prepared, it is deducted from the cost of the assets. Thus, the non-current asset figure in the statement of financial position is made up of two figures. That is the cost less accumulated depreciation. Good. So let's look at this example. An item of equipment costs 1,260,000. It has an expected useful life of 6 years, an expected residual value of 240,000. Using a straight line method of depreciation, what is the annual depreciation charge, and what will be the current amount of the asset after 4 years. Okay, good. So yeah, they are asking us the annual depreciation charge and what will be the current amount. Okay. All right. So the annual depreciation charge, the cost of the asset is 1,260,000 minus the residual value of 240,000, all divided by the rate, the number of years over 6 years. So we divide this by 6 years. So this is equals to 1,260,000 minus 240 divided by 6. That is 170,000. 170,000. Then let's do this every year. Okay. And what will be the current amount of the assets after 4 years? So let's look at so with this, if the annually, this is the depreciation charge, means that at the end, the accumulated depreciation at the end of the 4th year will be equals to 170,000 times 4. Okay, so 170 times 4 will be 680,000. Okay, 680,000. Good. Therefore, the carrying amount, that is the B part of the question, that is A. So the carrying amount at after 4 years, the carrying amount of the assets after 4 years will be equals to the cost of the asset, what is 1,260,000 minus 680. Okay, and that gives us 1,260 minus 680. That gives us 580,000. Okay, so to determine the annual charge, and since we know that under the straight line method of depreciation, The depreciation charge is the same for each full year. Now, you determine that. Now, if that is a full year depreciation, is 170. Now, the question is requiring the value of the assets after 4 years. So once we know our annual charge for the year to 170, it means that every year it will be 170. So times 4 will give us the accumulated depreciation at the end of the 4th year. Then we take the accumulated depreciation at the end of the 4th year from the total cost of the asset, and that will give us the carrying value at the end of the 4th year. Good. Now let's look at the next example. The next example. The financial year of a company is 1st January to 31st December. A non-current asset was purchased on May for 600,000. Its expected useful life is 5 years, and its expected residual value is 0. It is depreciated by the straight line method. Complete the following ledger account for the years 1st January. Complete the ledger accounts for years 1 and 2, and calculate the carrying amount of the assets at the end of each year. So we have the equipment account, we have the accumulated depreciation account, and we have the depreciation of equipment account. Okay, good. So let's see. All right. So here, I'm gonna open the equipment account. Open the equipment account. To open accumulated depreciation account. And then depreciation of equipment account. Good. Good. So you're saying that the financial year of the company is 31st December, the year end. So it starts from January and ends in the 31st December. And they acquired an asset on 1st May for 600,000. And this asset is expected to be used for 5 years and with a 0 residual value. And they depreciate the asset on straight line method. Great. So on acquisition, okay, on acquisition, the value of the assets, that is year one, it was on 1st of May of year 1. So let's say cash, that'll be 600,000. Okay, good. Now at the end of year 1, that is 31st December, of our balance carried down, 600,000. Okay, so we come to year 2. We come to year 2. So on the 1st of January, we say balance brought forward, balance brought down 600,000. Good. Now at the end of the year, we must charge what? Depreciation. We need to charge what? Depreciation. Good. So here the year 1 depreciation charge will be equals to the cost of the assets. Okay, the cost of the assets 600,000 600,000 minus scrap value, which is 0, divided by what? 5 years times the asset was acquired on May, so it became available for use on May. So May, June, July, August, September, October, November, December. That's 8 months. Okay, May, June, July, August, September, October, November, December. That's 8 months. Okay, good. So that will be times 8 on what? On 12. Okay, good. So this is equals to 600,000 divided by 5 times 8 on 12. So this equals to 600,000 divided by 5 gives us 120,000. So you have 120,000 times 8 on 12 times 8 divided by 12. That gives us 80,000. That gives us 80,000. Okay, good. So here what we do is that we debit our depreciation account, okay, on 31st of December of year 1. We have accumulated depreciation of 80,000. Okay, so year 1, this depreciation will be sent to P&L as of 31st of December of P&L, 80,000. Okay, good. Then this will be recorded in the accumulated depreciation account. So you come to year 1, 31st December. I'm using 31st December because we compute the depreciation at the end of the what? Of the year. Okay, good. So we have depreciation of 80,000. So at the end of year 1, that's the 1st December, of our balance carried down. Because this is accumulating, we are negating the depreciation that we will charge on the asset over its useful life. So that continues. Okay, however, the depreciation that we charge every year will be expensed at the end of the year. Okay, good. So that's 80. That's 80. So come to year 2. Come to year 2. So come to year 2, 1st of January. Balance brought down or brought forward. That will be 80,000. Okay, good. Now in year 2, we didn't acquire any new assets. So it means that at the end of year 2, as of 31st December, our balance carried out on our asset account will still be 600,000. Okay, good. Now at the end of year 2, we will still charge depreciation. Okay, now you can see that the annual depreciation is 120, but because the very first year. The asset was acquired in May, and therefore we use it for only 8 months. That's why we found 8 months of the 120. Okay, so it means that in year 2 we'll have a full year depreciation of what 120,000 because it's from sorry. Good. The very first one is for 8 months. That's why I find 8 months of the 1 year depreciation. But year 2 we have a full year. That is January of year 2 to December of year 2. So that one you have to charge a full year depreciation of 120. Good. So in year 2, in year 2, in year 2, okay, year 2, year 2, we have 31st of December, accumulated depreciation will be 120,000. Accumulated depreciation will be 120,000 Ghana cedis. Okay, so we've debited the depreciation account, so we need to credit the accumulated depreciation, the name of depreciation, that is 120. Okay, so at the end of year 2, we have a total of 200,000. 200,000. So at the end, 31st of December, our balance carried down as accumulated depreciation is 200,000. Okay, good. So at the end of year 2, that's 31st of December, this balance will be sent to P&L as a depreciation. Okay, 120,000. Good. Happy together. Good. And here we're to complete the ledger accounts. So these are the ledger accounts. And then at the end of year 2, to determine the carrying amount, and calculate the carrying amount of the asset at the end of each period. Okay, and to calculate the carrying amount of the asset at the end of each period. Now, we know that the carrying amount of an asset, the carrying amount of an asset is equals to the cost of the asset minus accumulated depreciation. Okay, minus accumulated depreciation and minus accumulated impairment loss. Here, there's no impairment loss, so the carrying amount becomes the cost minus accumulated depreciation. So year 1, we need to determine the carrying amount. What was the cost? It was 600,000, and at the end of year 1, the depreciation charge was 80,000. So the carrying amount at the end of year 1 becomes what? 520,000. Okay, 520,000. Good. Now, at the end of year 2, the cost is still 600, but the accumulated depreciation is what? 200,000. So minus 200,000, and that gives us 600 minus 200. That's what? 400. Okay, that's 400. Okay. Good. Good. So this is how we go about it. This is how we go about it. Happy together. Good. 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 So that is the how we account for non-current assets and depreciation. So we open the asset accounts. Open the asset account. That's equipment account. Then we open the depreciation of equipment account and the accumulated depreciation. Okay. Good. So let's continue. Let's look at subsequent measurement. Subsequent measurement, because we learned that an asset should be recognized initially at cost. Is there any other way to measure the cost of the assets or to measure the value of the asset after initial recognition? So we talk about subsequent measurement here. Talk about subsequent measurement. We talk about subsequent measurement. Good. So let's move on. So let's talk about the subsequent measurement of an item of PP or property, plant and equipment. Now, the standard offers two possible treatments here. The standard offers what? Two possible treatments here. Essentially, a choice between keeping an asset recorded at cost or revalue it to fair value. So two methods. Either you keep it at cost or you revalue it after your initial measurements. Good. Now the cost model means that carry the asset at its cost, less depreciation and any accumulated impairment loss. The revaluation model is carry the asset at a revalued amount, being its fair value at the date of the revaluation, less any subsequent accumulated depreciation and subsequent accumulated impairment losses. The revised IAS 16 makes it clear that revaluation model is available only if the revaluation, only if one, the market value of land and buildings usually represent the fair value. Okay, good. Market value of land and buildings usually represent fair value, assuming existing use and line of business. Such valuations are usually carried out by professional qualified valuers. So we use IAS 16, or IAS 16 makes it so the revaluation model is available only if the following are present: that the market value of land buildings usually represent the fair value, assuming existing use and line of business. Such as valuations are usually carried out by professional qualified valuers. In the case of property, plant and equipment, fair value can be taken as the market value. Where a market value is not available, however, depreciated replacement cost should be used. Now, the frequency of the valuation depends on the volatility of the fair values of the individual items of property and equipment. The more volatile the fair value, the more frequent revaluation should be carried out. So, if an item which is subject to frequent fluctuation or is volatile in nature, then we are saying that the more volatile it is, the more frequently revaluation needs to be carried out. All items within a class should be revalued at the same time to prevent selective revaluation of certain assets and to avoid disclosing a mixture of costs and values from different dates in the financial statements. Okay, all items within a class should be revalued at the same time to prevent selective revaluation of certain assets and to avoid disclosing a mixture of costs and values from different dates in the financial statements. Good. So now the revaluation model can be used. However, there are certain preconditions. You must make sure that those conditions are available before you cannot revalue. Okay. Good. And again, we have established that when you decide to revalue an asset, then all assets in that class needs to be revalued. Okay. Good. Maybe property, maybe motor vehicles, maybe buildings, maybe office furniture and fittings. It's a class of assets. So when you decide to revalue a particular an item in a class, then we are saying that all the items in that class should be revalued. So if it's motor vehicle, if you revalue one motor vehicle, all the other motor vehicles should be revalued. Good. Now, how do we treat the differences that will arise from revaluation? Okay, so treatment of revaluation what differences. Treatment of revaluation what differences. Now, when assets carrying amount is increased as a result of revaluation, the increase should be credited directly to equity under the heading of revaluation reserve or capital surplus. However, the increase shall be recognized in profit or loss to the extent that its revaluation decrease of the same asset was previously recognized in the profit or loss. So what we are saying here is that if you should revalue an asset for the very first time, and that results in an increase. For example, at the time of revaluation, the value of the asset is say 1,000. You revalued it, and the asset became 2,000. Like I said, that the asset has increased in value by additional 1,000. We are saying that that increase of 1,000 should be credited directly to equity under the heading revaluation reserve. Okay, good. So in this case, we'll debit the assets and credit the revaluation reserve. However, we are saying that the increase shall be recognized in profit or loss to the extent that its revaluation decrease of the same asset was previously recognized in profit. Meaning that if an asset is revalued for the very first time and it's a revaluation deficit or revaluation loss, okay, that amount of loss is recognized straight in P&L. So in that case, we credit the value of the assets, we credit the value of the asset, and we do what? We debit P&L in the name of revaluation loss. Okay, good. So when that happens, and on subsequent revaluation, it results in a revaluation gain. Okay, so maybe let me use the same 1,000 carrying value and revalue it to 2,000. Now there's 1,000 difference. So if the initial recognition was a loss, and therefore it was sent to P&L, and then subsequent revaluation, there has been a gain. We are saying that because the loss was recognized in P&L, that revaluation gain that has been that has arisen as a result of the subsequent revaluation, that gain should also be sent to P&L to the extent that it reverses the initial loss. Don't worry, we'll look at it practically and you have an understanding of that. Good. Then the B aspect is that when an asset carrying amount is decreased as a result of revaluation, the decrease shall be recognized in profit or loss. So that's what I explained. However, the decrease shall be debited directly to equity under the heading of revaluation reserve or capital surplus to the extent of any credit balance existing in revaluation reserve or capital surplus in respect of that asset. So simply put, when an asset is revalued for the first time and it's a gain, the gain is credited to revaluation reserve under equity. Okay, good. If it is a loss for the very first time, the loss is sent to P&L. Then, if on subsequent revaluation that results in a gain, then you do the opposite. Okay, good. So if it's a gain for the first time, it goes to equity. It's credited directly to equity and the revaluation reserve or capital surplus. Okay, if it is a loss for the first time, it is debited to P&L, because when it's a loss, it means that if an asset is 1,000 and you revalue it and it becomes 500, the asset has lost value. Is that not it? So we credit the asset account and we debit P&L, the name of revaluation loss. Okay, good. Then on subsequent, okay, measurement, if it's a gain, we are saying that because on first revaluation it was a loss and we took it to P&L. Now that we have gotten a gain, we can't send that gain, okay, directly to equity. Now we must send the gain, okay, a portion of the gain or all the gains to equity to the extent that it reverses the initial loss. So if the loss was 500 and now the gain, we have done a revaluation, a subsequent revaluation is 1,000. If the initial loss was 500, we send 500 to income statement to the extent that it cancels off that loss. And that difference of 500 will be credited directly to what? Equity. You get the point? Good. So that's how we'll look at it practically and you'll appreciate what I'm trying to explain. Okay, good. Good. Now, the revaluation surplus included in equity in respect of an item, property, plant, and equipment shall be transferred directly to retained earnings or income surplus when the asset is what? Derecognized. When the asset is derecognized. Okay. Now, as a matter of policy, some of the surplus may be transferred as the asset is used by the entity. In such case, the amount of surplus transferred would be different between depreciation based on revalued amount of the asset and depreciation based on the asset's original cost. Okay, we will discuss this also later. Good. Okay, so let's look at the revaluation of PP. Okay, now how do we account for the difference in revaluation, either as revaluation surplus or revaluation deficit? Okay, good. So let's look at when there is a revaluation and the revaluation leads to a surplus. How do we account for it? So example one. So quickly. Okay. So land was purchased for 100,000 on first day of 2016 accounting period. The business revalues land as permitted by the IAS 16. The land was revalued to 130 at the end of the first year of ownership. Required. Account for the difference. Good. So how to account for the difference? Good. So when there's a revaluation, what we learned was that if when the asset carry amount is increased as a result of revaluation, the increase is credited towards the increase should be credited directly to equity under the heading of revaluation reserve or capital surplus. Okay, good. So here, the assets in this question, the asset value was 100. It was revalued to 130. Okay, then we have to account for the revaluation difference. So what we do is that now, since there has been an increase in the value of the assets, right? Once there has been increase in the value of the assets, what we do is that we're going to debit. Okay, we're going to debit the we debit land uh, 30,000, and we credit revaluation uh, revaluation surplus or revaluation. Let me say revaluation reserve. Revaluation reserve. Credit revaluation reserve. Also 30,000. Okay. Good. So this is how we account for the increase. Okay. We debit land 30 and we credit revaluation reserve also 30. Okay. If you are using T account, okay, if you're using T account to do the account, so this will be the land account. Okay, land account. So you can see that the balance brought forward was 100,000. Okay, so on revaluation, there has been a revaluation reserve. So we debit this account in the name of revaluation. The name of revaluation reserve 30,000. and credit revaluation reserve account, revaluation reserve account, and we credit it the name of land, 30,000. Okay, so at the end of the day, we have 130. So at the end of the year, balance carried down is 130. Okay, so this one at the end of the year, balance carried down 30,000. Okay, good, good. So let's look at example two. Example two, revaluation downwards. Land was purchased for 100,000 on first day of 2016 accounting period. The business revalues land as permitted by A16. The land was revalued to 90,000 at the end of the first year of ownership. Required, account for the revaluation difference. Account for the revaluation difference. So here the revaluation resulted in a revaluation deficit. Okay, good. Now we learned that when there's a revaluation loss, when an asset is revalued for the first time, there is a loss. The loss is debited towards P&L, okay, and credited to the assets. Now the asset value is 100. That's be revalued to 90. Till the asset has lost value by what? There's a loss in value of what? 10,000. Good. So what you do here is to debit. So debit profit and loss by 10,000 and credit the land account, profit and loss account, credit the land account also by what? 10,000. Okay, good. If you are using T account, this is how it will look like. So let me say this profit or loss. So it's profit, loss, this land account. Okay, good. So here we debit profit and loss in the name of land, or revaluation loss. Let me say revaluation loss. So revaluation loss, revaluation deficits, 10,000. Land may have a balance but forward on the land to be 100,000. So we credit it in the name of revaluation. Revaluation. Of 10,000. Okay. Good. So at the end of the period, our asset value was 90. All right. So this is how you go about it. Okay, if you're using the T account. Okay. All right. So let's look at this example. This is a more detailed one. And look at how that will be done. All right. And yeah, then it's not difficult. So you just have to go through a number of examples and you'll be okay. Okay, it's not that difficult. Don't be scared. Just go through a series of questions and you'll be fine. Right? Good. Now, a business. Question 3. A business purchased a plot of land on the first day of 2017 accounting period. The business applies the IAS 16 revaluation model to the measurement of land after initial recognition. The business has a policy of revaluing land annually. The initial amounts recognized and the year-end values are shown below. Account for the revaluation difference. So initially, the asset was measured at 30. On 31st December 2017, it was revalued to be 130. Okay, good. So what we do here is that let's look at 31st December 2017, sorry, the revaluation has resulted in a revaluation gain. So what do? We are going to debit land account with 30,000 and we credit revaluation reserves also with 30,000. Okay, good. Now, at 31st December 2018, that's a subsequent revaluation. It's resulted in a loss, okay, of 110. Loss of it resulted in a loss of 10 because the value is 100,000. Okay, it's 100,000. Now, if the value at 31st December is 130, okay, it's 130. Good. So in 2017 year end, the current value was 30. Now on 31st December 2018, the value has now come to 110, meaning there has been a decrease of what? 20,000. Okay, there's a decrease of 20,000. Is that not it? Good. There's a decrease of 20,000. What you are seeing here is that decrease of 20,000. Okay, now ordinarily, if it is the first time, okay, we credit the what? The assets. Okay, and we are going to debit P&L. Is that not it? Good. But here, there's already a reserve of what? 30 on the revaluation of that same asset. The very first time we had a reserve of 30. So we are saying that now that it has resulted in a loss of 20,000, that is the difference between 130 and 110. The difference is 20,000. Now, we should rather, instead of debiting P&L, we should rather debit the revaluation reserve because it's supposed to reduce this balance. Do you get the point? Good. So here we debit revaluation, reserve. Okay, debit revaluation reserve by 20,000. The entire loss will be debited to the revaluation reserve account. Then we credit land account also with 20 because there has been loss in value. Good. I'll be together now. So now you can see that the reserve account, now there's a balance of what? 10,000 in there. Is that not it? Good. Then let's look at our next at 31st of December 2019. At 31st of December 2019. What do we do? Now, the assets, which was as of 2018 was valued 110, has now come down to 95. I've come down to 95. So what is the difference between 110 and 95? That is 15. That is 15. So now, if you look at this carefully, revaluation is 30. You debited with 20, so it's left with 10. So now, on this occasion, now the loss is more than the revaluation reserve left, or revaluation gains left. So what we do is that we are going to debit revaluation reserve with 10,000, because this 10,000 clears the revaluation reserve, and the remainder, that is the 5,000, we debit profit or loss with it, 5,000. Do you get the point? Good. Then we credit land account with what? The total amount of what? 15,000. So that's why we're saying that if on subsequent revaluation, first one, the initial revaluation, we got a gain, 30. The subsequent one, we got what? A loss. So we are saying that the loss should be sent to the revaluation reserve or credited to equity to the extent that it reverses the initial what? Gain. So that's what we did for the first time. And on subsequent, again, the second valuation, the loss didn't reverse all the gain. So the third revaluation also resulted in a loss, which is 15. And already we've sent 20 to the revaluation reserve. So it came to 10. The next was a loss of 15. So we can only reverse the gain to the extent that it nullifies it. That's why we sent 10,000 there. So you can see debit revaluation reserve, we have 20 and 10, that is 30, and credit is 30. So the account is off. You get me? Good. So now the loss, the difference of the loss should be sent to P&L straight. Okay, good. Now let's look at the next. As of 31st December 2020, at 31st December 2020, good. As at the end of 31st December 2020, okay, now the valuation is what? 116, from 95,000 to 116. 116 minus 95. That results in a gain of 21,000. That results in a gain of 21,000. Now, this gain, okay, we need to again reverse the loss of 5,000, which we debited P&L. Now we have to go and credit P&L, okay, with 5,000, okay, and credit revaluation reserve with the difference of 16,000 and debit the assets. So here we are debiting land. Sorry, you said. So here we are going to debit land, okay, with 21,000. They are going to credit P, profit or loss, with 5,000. So this 5,000 goes and clear off this loss, okay. Then we credit revaluation reserve with what? 16,000. 16,000. I hope I'm understood. Good. So initial recognition, if it's a gain, we debit the asset and we credit revaluation reserve. Okay, good. Or we credit the statement of profit or loss, the other comprehensive income. Okay, good. Then, if on subsequent revaluation there is a revaluation deficit or revaluation loss, now the loss should be sent to the revaluation reserve account to the extent that it reverses the initial gain. And here, the revaluation gain initially was 30. The subsequent measurement gave us a loss of 20. So we take 20 out of the gain of 30. It will be left with 30. On the third revaluation, there was a loss of 15. The loss of 15 means that 10,000 can be covered by the initial revaluation gain, and the remainder was sent to P&L. Then on the fourth revaluation, there was a gain. So that gain comes to reverse the loss of 5,000, and the remainder of the gain, which is the 16,000, goes to revaluation reserve. This is what has been demonstrated, and that is what we learned as to how to treat revaluation of differences. Okay, good. So now let's talk about changing the carrying amount of a revalued asset. How do we change the carrying amount of a revalued asset? Now, in our previous examples above, okay, in the examples that we just discussed, okay, in the examples we looked at now, land was revalued and land is not depreciated. So the carrying amount of land is represented in a single account. This made it easier to change. The carrying amount of depreciable assets is the net balances from two separate accounts. That's a double entry to revalue assets take into account. Let's take this into account. Good. IAS allows choice of two approaches which differ in treatment of the accumulated depreciation accounts. When an item of property plant agreement is revalued, any accumulated depreciation at the date of the revaluation is treated in one of the following ways. 1. Restates the accumulated depreciation proportionately with the change in the gross carrying amount of the asset, so that the carrying amount of the asset at the revaluation equals its revalued amount. And 2, transfer the accumulated depreciation to the asset account. The result of this is that the balance on the asset account is now the carrying amount of the asset, and the accumulated depreciation account is in respect of this asset is 0. Okay, good. And 2, change the balance on the asset account to the revalued amount. Good. Now we'll look at the example 2 because that's what is widely used in practice. So when an asset is revalued, okay, we are saying that we transfer the accumulated depreciation to the asset account. The result of this is that the balance of the asset account is now the carrying amount of the assets. Okay, and the accumulated depreciation in respect of this asset is nullified or 0. Step two is that we change the balance on the asset account to the revalued amount. Good. So let's look at example one. A building owned by a company is carried at 20 million, cost of 25 million, less accumulated depreciation of 5 million. The company's policy is to apply the revaluation method to all of its land and building. We can account for the changes in the current amount of revalued asset using the methods discussed above. Okay, so let's look at this example, how we change the current value of an asset where there is depreciation and all those things. In the case of land, land is not depreciable, and therefore it was pretty straightforward. Okay. All right. Okay. So we have a company owned by a building owned by a company is carried at 20 million, cost of 25,000, less accumulated depreciation of 5 million. The company policy account for the changes in the current amount of the using the good. So here we have our asset accounts. So we have the building accounts. We have the accumulated depreciation. Accumulated depreciation account. Okay, good. So now, building value brought forward is 25 million. So I'm going to put 3 zeros on top. Accumulated depreciation is 5 million. Good. So you are saying that to determine the current value of the asset under method 2, you are saying that transfer the accumulated depreciation to asset account. How do we transfer it? So we come here, okay, and we debit this account to the name of building account. So the name of building, 5,000. So this account is closed, and this transferred to this account. The name of accumulated depreciation, 5,000. Okay, good, good, good. So we say we transferred. The result of this is the balance on asset account is now the current amount of asset. The accumulated account is 0. Change the balance on the asset account to the revalued amount. So here, at the end of the day, the difference on this account is the revalued amount. Okay, it's a revalued amount, which is 20,000. So we have 25,000, 25,000. Okay, so that is how you can change an asset value to the revalued amount. Or anytime there's revaluation, first determine the carrying amount. So the carrying amount becomes the cost of the asset minus the accumulated depreciation. Okay. Okay, good. So first determine the carrying amount and compare the carrying amount with the revalued amount. Okay, that's an asset that is subjected to depreciation. Okay, good. So, excuse me, let me make this correction. For so by transferring the accumulated depreciation to the asset account, we get the carrying amount. So here, let me say balance carried down, which will be 20,000, represents the what? The carrying amount. So balance brought down of 20,000. This becomes the carrying what? Amount. That is the carrying amount. Okay, good. So let's look at example 2. One Touch Limited revalued its building and decided to incorporate the revaluation into the books of accounts. The following is relevant. Extract from the balance sheet at 31st December 2017. Buildings, we have depreciation. Depreciation has been provided at 2% per annum on straight line basis. The buildings were revalued on 30th June 2018 at 5,520,000. There is no change in its remaining estimated future life required. Show the relevant extract from the 2018 financial statements. Okay, good. Good. So now we have this question. Now, as of 31st December, the building was valued 6 million, and accumulated depreciation so far was 1.8 million. Okay, and depreciation has been provided at 2% per annum on straight line basis. Okay, good. The buildings were revalued on 30th June 2018. In June 2018, that was when the revaluation took place. And the assets were revalued to 5,520,000 Ghana cedis. And we are saying there has not been any change in its remaining estimated future life required. Show an extract from the 2018 financial statement. Good. How do we go about this? So first, we need to determine the number of years that the asset has been depreciated. Because if you know the number of years, that's when we'll understand by they saying that there's no change in its remaining estimated future life. Okay, and we have to show the extract from the 2018 financial statement. And 2018 ends in December. Okay, good. So first, we need to first determine the carrying value of the assets, the carrying value of the assets as of the time of revaluation. The carrying value of the assets at the time of what? Revaluation. What will be the carrying value at the time? The revaluation took place on what's it called? 30th June 2018. So that is halfway. So as of the time of revaluation, what was the carrying value of the assets? Okay, good. We have the accumulated depreciation up to 31st December 2017. So it means that from January to June 2018, we need to determine the depreciation. The rate of depreciation is what? Is 2%, right? It's 2%. It's 2%. So let's see. Depreciation. The depreciation that is from 1st of January 2018 to 31st of December, to 30th 30th of June 2018. Okay, that will be 6 million times 2% times 6 on 12. So 6 million times 2% times 6 divided by 12. That is 60,000. That's 60,000. Good. So let's look at accumulated depreciation. Accumulated depreciation as at 30th June 2018. That will be equal to the accumulated depreciation of 1,800 plus 60,000. Okay. And that gives us 1,800 plus 60. That's 1860. That's 1,860,000. Okay, that will be the accumulated depreciation as of 30th June 2018. Now, we don't need the depreciation, we need the carrying value. So this is the determination of carrying amount as at 30th June 2018. Therefore, the carrying amount is equals to 6 million minus 1,860,000, and that gives us 60 minus 1860. 60 minus 1860. That is 4140. 4140. That's the carrying amount. Okay, good. Now this carrying amount must then be compared with the revalued amount. Okay, this carrying amount must be compared with the revalued amount. Okay, good. So now the revalued amount. So let's determine. Let's determine determination of revaluation difference. Okay, determination of the revaluation difference. Good. So revalued amount is 5,520. We compare this with the carrying amount, which is 4140. So there is a gain of 5520 minus 4140. So there is a revaluation gain of 1,380. So don't forget there's working in million. Okay, good. So that's the revaluation gain. Now this is not what we're to do. We are to do the extract from the 2018 financial. So all these are workings. Okay, Good. So let's look at after the revaluation. After the revaluation, okay. After the revaluation, now from July to December 2018, okay, because you have to show the relevant extract from 2018 financial statement. 2018 financial statement ends in 31st December. So after the revaluation, we need to know the remaining life of the assets left. Okay, so determination of remaining useful life. Let's look at determination of the assets remaining useful life. Okay, good. Now, when we say an asset is being depreciated by 2%, now 100 divided by 2 is 50. So we are looking at 50 years. So useful life is 50. Okay. Now let's look at uh, the expired useful life. Okay. So let me take first the accumulated depreciation. Now the accumulated depreciation was 1.8. Okay. Now this divided by 2. Okay. Or this divided by that 1.8, the 1.8 or 1.8 million divided by the annual depreciation charge, that is 6 million times 2%, that is 120. So we divide this by 120, we'll get to know the number of years depreciation that the 1.8 million represents. You get me? The annual depreciation charge is 2% of 6 million. Okay. So this is 6 billion because there's million on top. So 6 billion. 2% of it gives us 120 million. Okay, good. Now, and we have accumulated depreciation of 1.8 billion. Okay, so when we divide the 1.8 by 120, we get to know the number of years depreciation that we have charged so far. That is up to 31st December 2017. Sorry, the accumulated depreciation up to 31st December 2017 is 1.8 billion. So how many years have we depreciated this asset to get the 1.8 billion? Good. So we have to divide by the annual depreciation charge, which is 120 million. Good. So now 1.8 divided by 120 gives me 15. So that's 15. Okay, that is 15. Good. So that's the accumulated depreciation so far. Okay, good. Now, then we charge current year depreciation. The current year depreciation. Current year the current year depreciation, okay, which is 60. Now 60 divided by 120. 60 divided by 120, that is 0.5. That's a half year. Do you get it? That's half year, so 0.5. Okay, so when we sum up this, we are deducting this one from it. That's the expired. So 50 minus 15.5 gives us 34.5. Okay, 34.5. That's 34.5. Good. So that's the remaining. That's the remaining useful what? Life. That's the remaining useful life. Good. Good. So now let's look at the charge, the remaining depreciation or depreciation to be charged for the next half of the year. The depreciation to be charged for the next half of the year. Okay. So that one we have depreciation for the next 6 months. The next 6 months. The next 6 months we are looking at 1st of July 2018 to 31st of December 2018. First July 2018 to 31st of December 2018. All right, great. Now, in that case, the carrying amount of the asset is now 5,520,000. That is, it was revalued as of 30th June to be 5,520,000, 5,520,000,000. Okay, good, 5,520,000,000 Ghana cedis. Good, that's what it was revalued to. Good. Now, so that becomes the cost, more or less the cost from 1st July going. Good. And we have also determined the remaining life after revaluation. So this asset has a remaining useful life of 34.5 years. So the depreciation for the next 6 months. Okay, that's what you're finding. So the depreciation charge for the next 6 months is equals to 5,520,000 divided by 34.5 years times 6 on 12. Okay, times 6 on 12. Times 6 on 12. And that gives us 5,520 divided by 34.5 times 6 divided by 12. And that gives us 80. Okay, that's 80 million. Okay, because there's million on top. Okay, good. Now, the requirement was for us to show the extract from the 2018 financial statements. And the financial for 2018, we are looking at the statement of the income statement of profit or loss and comprehensive income, and the statement of financial position, how this will be done. Good. So let's see so far, what have we done? We first looked at the carrying amount, okay, just to help us determine the revaluation gain or loss. Because when an asset is revalued and the asset is depreciable, the first thing you have to do is that what is the carrying amount at the time of revaluation? You need to know. Then you compare the carrying amount with the revalued amount. That will give you the revaluation gain. Good. So In establishing a revaluation gain, first you need to determine the current amount of the asset. So that's what we did. First determine the current amount, and next determine the revaluation difference. And we realize that the revaluation difference is a gain. Okay, good. When it's a gain, it means that you have to debit the asset and credit the revaluation reserve. Good. Then afterwards, you need to determine the here. We needed to determine the number of years that the assets has to go, or the estimated remaining useful life, because the asset was revalued midway through the year. So it means that after the revaluation, you must continue the year's activity. So again, you need to determine the depreciation after revaluation, and to do that, you need to know the remaining life of the asset after revaluation, so that you depreciate the asset over that remaining useful life. Good. So that is why we took the pain to look at the useful. I want to say 2%. 2% is 50, equivalent to 50 years. That is 100 divided by 2. Okay, that gives us the 50 years. Okay, good. That gives us the 50 years. Then we look at the expired useful life, and we get the expired useful life from the accumulated depreciation so far. From the question, accumulated depreciation as of 31st December 2017 was 1.8 million. The 1.8 million, it's 1.8 billion, because there's a million on top. So 1.8 billion divided by the annual depreciation charge. How do we get the annual depreciation charge? It is 2% of the cost of the building, which is 6 million, and that gives us 120 million. So 1.8 billion divided by 120 million gives us 15 years. So that needs to be deducted. Then don't forget that the revaluation was done midway through the 2018 financial year. So January to June is 6 months. So that's a half year. So that's how come we got this 0.5. Okay, this how come we get this 0.5. So when we take this 15 and a half years from 50 years, we get 34 and a half years. Okay, so 34 and a half years. Good. And so it means that from July of 2018 to December 2018, the asset has a remaining life of 34 and a half years. Okay, which asset needs to be depreciated over. So we went ahead to determine the depreciation for the next 6 months. Which is the carrying amount. Because as of 30th June, the building value was no longer 6 million, it was 520. So that goes off. So now we take the carrying amount as of 30th June as the new value of the assets and depreciate it over the remaining useful life. I'll be together. Good. So we have 520,000 divided by 34.52, giving us the depreciation for the next half year. So you can see that our total depreciation for the year. Now let's look at our total depreciation for the year. Total depreciation for the year. Now that will be equal to the initial depreciation charge. The initial depreciation charge, which is 1st January 2018, 30th June 2018, which is 60,000. Okay, so it is 60 plus 80, and that gives us what? 140. Okay, 140. That's the total depreciation for the year. Okay, good. So let's look at our extracts, our income statement extract. So you have One Touch Limited, One Touch Limited, One Touch Limited, One Touch Limited. So we have income statements, We have statement of profits or loss and other comprehensive income. Other comprehensive income for the year ended 31st of December 2018. So here we have our depreciation of million on top of 140. Depreciation of 140. Then we have other comprehensive income as the revaluation gain. The revaluation gain was 1,380. Okay, good, good, good. So these are the two things that will come into the income statement extra because depreciation is charged to P&L. Then we look at our statement of financial position as at 1st of December 2018. Okay, good. So here we have our non-current assets. Okay, our non-current assets. Our non-current assets. So we have our property, plant, and equipment. The cost of 5,520,000. Then we less the accumulated depreciation for 2018, which is 140. Okay, it's 140. I can, okay, let me do it this way. Okay, wanted to deduct it straight from the 5520 minus 140. 5520 minus 140,000 minus 80,000. Now, why 80,000? 80,000 because the 520 was the revalued amount after June, or is the revalued amount as of June. So the initial, that is depreciation from January to June, has already been factored. Okay, before arriving at this 5,520,000. Okay, good. So to do the depreciation or the carrying amount of the asset after the revaluation, it is the depreciation charge after the revaluation, which is 80. Good. So 5520 minus 80, that gives us 5,440,000. Okay, because this value is the value at 30th June, and after 30th June, then we charge another half-year depreciation. So it's the half-year depreciation that we need to deduct from this cost. Good. Then under our equity, we have what is called the revaluation. We have what's called the revaluation reserve. The revaluation reserve. And that is the 1,380. Good. So this is how we go about this. So you see that small question and the series of events that have gone on. Okay, good, good. All right. So we so I'll end here on the changing the carrying amount of a revalued assets, changing the carrying amount of a revalued assets, then continue our discussion later on. Okay, where we will wrap up on the whole accounting for non-current assets and depreciation. Okay, good. I want us to have some quality time to go through the remaining so that we don't rush through it. Okay, good. So at this point, I'll end here. Then we continue later to take our time and conclude properly so that we touch base on all the nitty-gritties. Good. Please, as I always say, go through, after going through the videos, make time on your own to solve other practical questions. The past questions on the CE website, you can download them and make use of them. The Institute manual is there. The question bank is there. When you buy the Institute book, they add the question bank to it. So please grab the copies of the manual and the question bank. Then supplement that with past questions and the lecture notes that I'll be sharing with you. Okay, practice more, and I'm sure when you do so, you'll be smiling by the time the November sitting results is released. Okay, I'll give you all my best, and you need to also pull your weight to make this a success. Okay, so on this note, I'll end here, and then we continue later on. Do enjoy the rest of the day.